Good afternoon and welcome to the Blue Line Metals Edge here for Thursday, February 9th. I'm Philip Strebel, Chief Market Strategist at Blue Line Futures. If you haven't checked out our YouTube page, we do have a lot of videos on here. We cover all the different markets, whether it's myself, my partner Bill Baruch, or Oliver Slope. He does a lot on the grain markets here, which have just been on fire. So if you're watching this via email, you can always hit the subscribe button, like our videos, help us try and build out this channel. So getting into the wood here, looking at that CPI number that came out, many of you I called yesterday, let you know that, hey, we want to liquidate some of our metals, lighten up on the positions, also take a short position on U.S. equities heading into this number. We expect the number to be hotter than expected. Most of the analysts thought that it would be about 7.2 to about 7.4 year over year on CPI. It actually came out at 7.6. And you can look here, the this month over month, we had also blown away the expectations. It was previous was 0.4. They were expecting 0.5, came out 0.6. So long story short, this inflation's red hot. And if you look at how the market is right now, I would expect this to carry over for multiple months. So, and then another tool that I wanted to bring up, because CPI comes out hotter than expected, Federal Reserve's going to find themselves farther behind the curve on fighting and, hiking interest rates, fighting inflation. So this is a great tool that all you guys should have bookmarked on at the top of the toolbar. It's a CME group. It's the Fed Watch tool. And what it does is it'll give you a breakdown on, what the probability is of them hiking. Here it shows you the March 16th meeting. There's a 100% hike probability. Now, what that probability or what that hike is, whether it is a quarter basis point or it is a half a basis point, it breaks down there what this current target is. So it's about a 69.5% chance that they're going to hike at least 50 basis points. From 25 to 50, it's only a 30% chance. And you can kind of go through and you can see, hey, in May, there's a 100% chance. You go to June, 100% chance. Let's skip all the way out to February. It says 100% chance. So this is when you hear that they're talking about, 6 interest rate hikes or, so many interest hikes out there. These are the ones that they're talking about. Now, if you go farther out, let's even see. This thing's really pricing it in all the way out there. They might be smaller interest rate hikes the farther you get out. They might only do 10 or 15 basis points, but that's the story. So just bookmark this page. Just trust me. Now getting into the wood here and looking at some of these different markets, let's start off here. U.S. equities, you could see that after the number, again, this is a daily chart, big high or low. We retested yesterday's highs. I tried to short it with a lot of people right up at the top. We missed it by 1 point, which is kind of frustrating. But, if you look here, we break it down into 5-minute chart or the daily, an intraday chart. Here was the action. CPI comes out hotter than expected, and mind you, our sells were at 45.86. It got up to 45.85. Can't believe we missed it. But anyways, so sells all the way off. It looked really ugly in the pre-market. Someone came in afterwards, bid it all the way back up. I don't know. It could have been plunge protection team. Who knows? Almost fills us again on that high, and then here we are waffling around. So, you look at the strength of the trend, going back to like the daily chart, the ADX, which measures the strength of the trend, that upward trend here is really kind of failing. And then you look at stochastics, we're reaching overbought territory, signaling into a lower high. So, and you're probably going to see the DMI minus cross over the DMI plus. I really think this thing's going to go into a bear market. I think we could see something like, where we actually like flag lower like that coming out as the Fed tightens. Remember, tightening into a weaker economic cycle, not good at all. And with rising and sticky inflation, that's really bad for the economy. So things are going to get more expensive. People are going to have less money. There's going to be less growth out there. So that's the point. Getting into the gold market. So gold on the number, we had started to back off. Let me pull it up in a 5-minute chart for you. So this was the action on the number. You had this sell-off coming into it. It kind of held on pretty good. We liquidated some positions and things like that. Anyone overweighted or, needing to take the dough. We took the dough. Market sells off. I really thought we would have got more of a breakdown. So market comes slingshotting back. That was kind of wild. It came back up because the U.S. dollar started to sell off. So yields are going up, but the dollar's weakening. Very strange. Somebody's wrong in this market. Some big participant is wrong. Either it's somebody with, large currency position or on interest rates, and they're kind of jockeying the market around. So as the days progressed, there was several stories that came out on Russia. They had they're practicing some like war games in Belarus right now. So I think that there is some added geopolitical tensions and risk going on. So we're seeing the gold market kind of coming up, drifting higher here. No real true breakout at all. And, I did say that, if we take this off, we're a little bit in no man's land. I'm trying to get ahead of it. It's that downward trend right there. So we might come back up and kind of test this level. Now, where I think good support's going to lie is right around this 200-day moving average and just below it. So, expect getting a phone call from me scaling in at these lower levels here. We're still, a ways away from overbought territory. The ADX kind of middle of the trend. It's really looking at this larger picture that we're just sideways. DMI minus crossing over, or DMI plus crossing over DMI minus. So you'll have people in systems that will activate, especially the people that use like Wells Wilder systems. They're all going to be long on this at the moment here. Getting into a couple other markets, soybeans here made a breakout high on, there was a revision on the Brazilian government. They had reduced the crop size significantly. The number is a little shocking. So that kind of blew out to the top. Saw so many people taking profits up there. Here's a market that's been kind of dancing around here. Doesn't know if it's going to break out or not. It's the platinum market. Platinum, there is a lot of platinum there, and those auto facilities are offline, so I'm a little hesitant to try and buy a breakout in that market. I think it might dance around, stay within this particular square there. Here's the dollar. This is the chart that I want to really show you. Go to a 5-minute on the dollar index. So dollar index spikes, right? You're going to get all these interest rate hikes. This inflation's sticky. They got to go at least 50 basis points multiple times to get this thing under control. So dollar's up, and then all of a sudden it broke down. And this was really what gave that gold and that silver, that little tailwind there to recover and start to move higher. And probably what they're thinking is there's an overreaction of that euro currency where they had indicated that, remember the stocks got the boost that the guy came out, their ECB, one of their Fed type guys, comes out and says that, hey, they can't do 2 interest rate hikes. Well, now they're probably saying, well, if the inflation's this bad in the United States, it's probably that bad over in Europe, and that's how, then they got to get that under control. So that's why the euro goes up, dollar goes down, gold and silver get a small boost. So again, those are, a few of the markets, couple standouts here. Here's a daily chart on Treasuries. You should all know this one. This thing's been consistently sliding, breaks down, makes a lower low. So yields right now, they're right at 2%. Goldman Sachs came out with a target of 2.25% by year end, but not sure if we're going to get that high. What I really think will happen is that the economy is going to slow down. The rate of change on job growth will decelerate. Economic data will decelerate. I think inflation is going to remain sticky. So high inflation and lower growth, and they're tightening aggressively. I think that's where a policy mistake comes in play, and that's why the U.S. equities, we've got bearish positions on, or at least options going farther out. So that's my 2 cents for today. Be sure to check out Kitco tomorrow. I'll be writing an article on there, posting it, maybe with a new strategy on gold, silver, way to get in there, on a couple other markets here that we're looking at. If you have any questions on futures option trading, don't forget to give us a call, 312-858-7303. Remember, futures and option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.